So you've all had your lunch, and this would now sometimes be the nap time, but we're not going to do that because there's a man with cameras and he's going to be taking photos, and it's going to be super embarrassing if you're asleep when he takes the photo, which will go on the website, so no pressure. Also, the next speaker is awesome and amazing, and you don't want to miss her. This will definitely be a lively spot, and if you haven't had the chance to hear from Sarah Breeden before, then go on the internet and have a look. But you'll also get to hear from her today. She's the Executive Director of Financial Stability for the Bank of England and also the sponsor for their work on climate. She's going to talk to us about the nature of risk. I think it's the risk of nature of risk. You see the double? Yep, you get that. And for me, is one of the most compelling speakers on climate. I'd like to welcome her to the stage, Sarah Breeden.
Thank you very much for that very warm introduction. I sort of feel you've bigged me up. If I was you, I'd have a bit of a nap. But I'm really pleased to be here 3 years on from when I was last here talking about climate, and now we're talking about nature. Nature underpins everything that we as humans do, from the water we drink to the air we breathe and the creatures and plants that sustain us. However, the world's leading scientists are concerned that nature is witnessing a global decline that's unprecedented, accelerating, and largely caused by human activity. The global decline can be seen here in the UK too. The ONS estimates that the value of the UK's natural capital stock declined by 10% between 2010 and 2018, and here in Scotland, over 80% of peatlands are now deemed to be degraded. Now, there's no denying that this is a pressing issue and one that governments and society should make every effort to address. In fact, the Chancellor's March 2021 FPC remit and recommendations letter asked the Bank of England's Financial Policy Committee to consider the relevance of environmental risks beyond climate change to its objective of financial stability. And so the question for me, as central banker and financial regulator, is what should my specific role be in this space? What action can and should the Bank of England be taking? Asking such a question about an environmental issue is not a novel experience for us. We asked that very question back in 2015 when first considering climate change. With climate and now with nature, we look to our statutory objectives, most obviously for financial stability and the safety and soundness of firms, and our remit to determine the appropriate response. And what I want to do today is unpack our current thinking on this important topic. I'll explore the nature of these risks, that fabulous pun, to consider both their link of nature to financial losses and the potential materiality of those losses, and whether they exhibit traits that are sufficiently distinct from those captured in the existing regulatory regime to suggest bespoke action might be warranted. Now, these may sound like simple questions. However, I can tell you unpicking the answers involves a level of complexity that's unusual even in the central banking world. The first step in our analysis has been to determine whether nature loss and degradation gives rise to financial risks. Now, we're fortunate here because we've got pioneering work of others that we're able to draw on, the Desgopta review, work from our central banking peers in the Netherlands and in France, holistic analysis from the Central Bank and Supervisors Network for Greening the Financial System, and the work being done by the Task Force for Nature-Related Financial Disclosures. We've also been able to draw on our work on climate-related financial risks where some parallels exist. For example, nature-related financial risks share many of the characteristics that make climate risks hard to assess: non-linear, far-reaching, subject to tipping points and spillovers. Some nature risks are arguably more reversible than climate risk, but they also present novel and challenging traits. Nature risks come from an immensely broad and varied range of sources with numerous interdependencies. That means there isn't a single metric to measure the condition of natural assets like temperature for climate risks, and there are countless transmission channels through which financial risk might arise. Compared to climate change, nature loss and degradation is more a local than a global issue. Nature risks are more likely to be material in economies that are more directly dependent on natural assets and their services. To give one example, Costa Rica's tourism industry, which generated nearly 11% of GDP in 2019, relies on its natural assets. Nevertheless, globally interconnected supply chains can cause local nature risks to spill over to other countries and regions. And then thirdly, there's no net zero for nature. There's been increased talk of an end goal being a nature positive economy, but without a clear definition of what that comprises, it's hard to quantify the risks from a transition to it. So what we have is an immensely complex set of risks that we all need to understand better. We and our peers have sought to do this by looking at the risks in a methodical way, and that's helped by adopting the physical and transition risk lenses that we use in climate, and I just want to explore each in turn. Nature-related physical risks are a direct result of a dependency on nature, whether that's air, water, land, minerals, or species. Any change in the quality or quantity of natural assets first hits real economy companies who depend on the ecosystem services that those assets provide. This can feed through to financial institutions that finance, insure, and invest in those companies. Now, the scale of this impact is hard to estimate. Using the Encore database, internal Bank of England analysis found that over half of UK GDP and nearly 3/4 of the stock of UK lending exhibits dependence on ecosystem services, levels that might perhaps suggest elevated vulnerabilities. But dependence on ecosystem services is a somewhat abstract concept. Let's dive into a specific channel of risk to make it more tangible. We chose the provision of fresh water. Now, water provision is a growing global issue. Demand is expected to be 40% greater than supply by 2030. As well as having an acute humanitarian impact, a lack of access to fresh water could disrupt economic activities, resulting in declines in asset or collateral values or lower profitability for companies in the real economy that are dependent on water either directly or through their supply chain. Financial firms exposed to these companies could see heightened financial risk as a result, materializing as credit, market, or liquidity risks. What could this mean in practice? I'm afraid to say analysis in this space remains light, but the World Bank has estimated that water scarcity could impact GDP by up to 6% in 2050, in some regions, such as the Middle East and the Sahel in Africa, as it affects agriculture, health, and so incomes. And HSBC have modelled disruption to water supply in East Asia that led to steel companies' turnover falling by 25% and a significant downgrade of credit ratings. At first glance, these figures might suggest the absence of fresh water could have potentially material implications for financial risks within financial institutions exposed to them. But this is the gross risk. To understand the likelihood of a feed-through to financial firms, we also need to understand mitigating actions that might net this off. And as ever, this is complex. In the UK, the water regulators are tasked with securing the long-term resilience of the water supply. In times of stress, they can reduce pressure by transferring water between regions, introducing restrictions on water use. We're seeing those at the moment, or undertaking desalination. And that would, of course, dampen the impact on companies and so the risk to the financial sector. But that's the UK, which has a developed water infrastructure. The situation in other countries might well be different. And we also need to consider how individual companies might respond to and what that might mean for their financial risks. This example, I hope, helps to show how physical, nature-based changes can give rise to financial risks. But this is just one risk. There are a myriad of other sources, from air pollution to food provision to flood regulation, each impacted by the actions of real economy regulators as well as individual companies. It is an unprecedentedly complex area to assess. The other bucket of risks are transition risks, which stem from changes in policies, technology, or consumer sentiment that aim to reduce or reverse nature loss. And so it follows that companies that negatively impact nature are more likely to be exposed to these risks. In theory, this is similar to the climate risk framework. However, in practice, defining transition risks for nature is much more challenging because we have neither a single net zero for nature measurement metric nor a global commitment to deliver it. Efforts to agree international nature goals are growing, and an important milestone will be the UN's Biodiversity Conference, COP15, later this year. Nevertheless, although we lack a comprehensive global policy framework for nature loss, we are increasingly seeing more narrow policy measures that give some indication of potential risks. For example, the UK government has proposed to make it illegal for large corporates to use commodities associated with deforestation. This would likely increase input costs for those companies exposed to deforestation, with implications for supply chain operations, asset values, and location of activities. These changes would therefore be expected to impact the financial sector too. The materiality of the impacts is hard to determine, but some analysis exists. Make My Money Matter estimated that 306 billion of UK pension funds are invested in companies linked to deforestation. All of this is expected to remain a challenge, whilst poor visibility over supply chains and related exposures persists, an observation that we highlighted as important for risk assessment in the Bank of England's recent climate scenario exercise, the Climate BES. What we can take from this analysis of physical and transition risks is that the link between nature and financial risk can be demonstrated. However, it's clear that there are significant challenges in identifying and sizing nature-related financial risks. Understanding the materiality of these risks is a key part of the jigsaw, and the work of the TNFD will be essential to progress here. And to improve our understanding, the bank is engaging with DEFRA and partners to better size the potential UK financial exposures from nature loss and degradation, and we'll look to share the results of that next year. Let me now turn to another key consideration, whether nature loss and degradation exhibits traits that are sufficiently distinct from those covered in our existing regime to suggest a need for bespoke action. This is a more conceptual question, and one that we grappled with at the Bank of England with climate risks back in 2015. I like to characterise climate change as two tragedies: a tragedy of the commons and a tragedy of the horizon. In a tragedy of the commons, it's difficult or costly to exclude users from common resources which are overused as a result. The typical policy response here is property rights or supply management, responsibility for which sits with real economy regulators and government. Now, those real economy policy responses can create financial risks for corporates and households and so financial firms. But assuming there's good sight of policy and disclosure of the potential exposure to these risks, the existing financial regulatory regime should, again, excuse the pun, naturally capture them. On this basis, there'd be nothing extra for the financial regulators to do beyond checking that material risks are being captured as we would do with any other emerging risk. The position is, however, different for a tragedy of the horizon. Here, actions today create future financial risks that fall outside of normal planning horizons. In this case, specific intervention from financial regulators is warranted to stretch firms' horizons and so ensure that they are considering the long-term financial interests of the firm, including how their decisions today affect their future financial risks. And that has been an important factor underpinning financial regulatory interventions on climate. To help judge the appropriate role for the Bank of England in respect of nature, therefore, we need to explore whether nature loss and degradation represents a tragedy of the horizon, a tragedy of the commons, or both. Now, obviously, nature loss and climate change are inherently interlinked. Some of the factors, such as deforestation, that increase climate risks also negatively impact nature, and vice versa. Nature, therefore, has a critical role in the climate challenge in mitigating physical risks using nature-based solutions and in acting as a carbon sink. And the financial regulators' response to climate risk should take this into account. What's less clear to me at this stage is whether the bank has a role in responding to those nature risks that are not directly connected to climate risks. Put another way, are there other aspects of nature loss and degradation that give rise to irreversible future risks that need to be addressed by financial regulatory action today? I think there's more analysis to be done here. Now, of course, what is clear-cut is that nature loss and degradation represents a tragedy of the commons, giving rise to real-life issues now that governments and real economy regulators are addressing. And so, alongside their critical work to improve management of climate risks, financial firms need also to monitor how environmental regulations develop. As Emma Howard-Boyd stressed in her final speech as chair of the Environment Agency, environmental regulation works in lockstep with financial regulation and economic regulation to drive change, and in this way, finance can be a force for good. Let me conclude and give you an opportunity to wake up. The bank's early work suggests that nature loss can lead to financial risks, but more work is required to help us determine their materiality to the financial system and the extent to which they are already captured in our regime. We've previously highlighted the critical role of financial regulators in helping address the tragedy of the horizon, ensuring that firms consider now how actions today affect their future financial risk. And it's clear that the interlinkages between nature and climate change mean that nature loss and degradation can represent such a tragedy. However, the extent to which this tragedy extends beyond areas linked to climate is an area where further work is needed. Looking forward, through our collaboration with DEFRA and partners, with our work with the NGFS and the TNFD, we aim to build a clearer picture of the nature-related financial risks facing the UK. And alongside this, we'll seek to clarify if and where nature loss can give rise to material financial risks that are not already being captured in our regulatory regime. Addressing nature loss and degradation is important to all of us on the planet, and in the round, this work will allow us to determine the nature of those risks, and so enable the bank and the financial system to play its part in the collective response to this critical challenge. Thank you.